Good evening and welcome to the FITT Show, which stands for Financial Information for Today and Tomorrow. My name is Bobby Kinzer, and that's my good partner, Thomas Doty. This show is dedicated to giving you tips and strategies and methods and recommendations on how you can get on the road to creating wealth, which lead, we hope, to generational wealth. Now, we're here every Thursday at 8 p.m. So make sure you tell your folks, tell your friends, grandmothers, and this information, you all, is definitely for you, but it's not just for you. We want you to share this information with your family and your friends. Because the one thing for sure that we usually lack, that is information. And the second thing is misinformation. So we try to bring you clarity and information, facts, and we also try to provide you with other little tips that would help you to get ahead in this financial mainstream. So like every week, I ask you, please make sure you click on the thumbs up button, because that really helps us reach more people. The more times you hit it, you can't hit it enough times, you all. So please do that for us. And also click on the heart or the face. And put comments in the comment box. But don't just use the comment box for comments. We're hoping you use the comments for questions, or if there's some things that we weren't clear on, we'll go back and clarify it for you. But all you got to do is put it in the comment box. But remember, the more you put comments in, the comments actually give us an opportunity to reach even more people than just doing the like button. So make sure y'all do that, because it really helps us. So with that, just want to get this show started. Last week, we talked about the FITT model that we created called Creating Wealth Model. And it's all the components that we've been talking about. This is our 13th show, and we put them all together in a model. And this is just building on that model. So with that, I want to pass you on to my good partner, Dote. How you feeling, the Dote?
I am doing great today. How are you, Big Bob?
Oh, man, I'm good. And, I got to tell you something, man. You looking marvelous. You starting to look more and more like Yul Brynner every day. I'm telling you.
Come on,
so,
man.
What we talking about this week, though? What's our favorite topic this week?
We're going to talk about home ownership. And I mean, that's most people's major investment is in their house. And unfortunately for a lot of people, that's their only investment. And we spent several shows talking about the benefit of having a diverse portfolio of assets. And that's well and good. But I personally think that you start with home ownership. That's kind of your base of where you build from. And the reason I feel that way is because you have to live someplace. You have to have a place to live. The government subsidizes, in most cases, not in 100% of the cases, but in most cases, the government subsidizes the house of home ownership. And if you decide to sell and move up, as long as you don't make over $500,000, you can reap that gain tax-free. And over the long run, housing costs typically rise about 3.5% per year. I mean, it used to be a time when you could buy a house and you were guaranteed that it was going to go up tremendously. And in some locations, that's still true. Not all. And everybody remembers the housing bubble of between 06 and 08, where a lot of housing values went down. So it's not guaranteed, but over the long haul, you're typically going to see a 3.5% increase per year. So that's our subject for tonight. And we're going to give you some background on how to best get into that area of investment.
And there are actually two main ways to create wealth, and that would be owning a home and investing in the market. Now, since the beginning of time, private property and home ownership has been a proven path to store and create wealth. So tonight we're going to talk about the ongoing conversation about renting versus buying, all those type of debates, and we're going to just share our thoughts with you about that. So we want to start off tonight with this main subject. Boom. Here we go, Dope.
Okay, and the first issue is renting or buying. And there's a bunch of pros and cons, which we'll get into in a minute. But start at the top. You think of your age. When you're younger and just starting off, it's probably most advantageous to rent. You typically don't have a down payment. And also when you get older, it's advantageous to rent because you don't have to worry about maintenance. You can just kind of, if something breaks, you can call somebody. So that's a major component or decision point in deciding whether to rent or buy. The condition, I mean, if you want to buy a new house versus you want to rent in a new place, that can drive your decision. Amenities, accessibility. Unless you move into a resort type neighborhood that has a lot of amenities, oftentimes you'll find apartment buildings that have gyms, swimming pools, and bars and things like that. Location is obviously an important factor because if you live in New York, San Francisco, Chicago, it's a little bit harder to buy in those areas because the price is so high. Also in San Francisco. And so you might be forced to rent just because of the cost. Neighborhood is a major factor, where you want to live. Unfortunately, most houses appreciate better in the suburbs. And a lot of the inner city houses do not increase with the same speed that they do in the suburbs. Improvements. You can buy a fixer-upper and put a lot of sweat equity into it and make some money. And finally, interest rates. If interest rates creep up, it's going to be a shock once they start going up because they've been down for so long. And obviously that would have a tremendous effect on the price you pay for a house. And finally, the market. I would hate to be looking for a house in this market today because, I mean, it's crazy everywhere buying a house. There's multiple offers. There's escalation clauses. People are bypassing inspections. People are bypassing appraisals. And the other thing is a lot of investors are buying houses with cash. So they come in and plunk that on the table, and that pretty much seals the deal. So it's typical out there for buying a house. But as most things go in cycles, this will also go in a cycle. And at some point, it's going to come back around where it'll be a buyer's market. But right now, it's definitely a seller's market. So all those factors to consider if you're looking whether to rent and buy.
So I just want to remind people that if you're on now, this early, and you think we're just going to be talking about, buying a house, you stay on because we're also going to be talking about if you own a home and the things that involve with that too. So this is all about home ownership, period. So stay with us. No, next thing I want to talk about is advantages of renting a home to rent. There's no property maintenance. Rental contract is for a year. You can have a rental contract for a year or less, and no homeowner associated costs. That is a big plus for renting, right? And the disadvantages are you're not the owner. Your rent might increase and you might not be able to renew your contract. Now, owning a home, the advantages are building equity and borrowing against it. That's when the value of your home increases the purchase price. That's what equity is. That's what everybody hopes for. In most homes, that's what it actually does. It's a great investment. It's not just good because it becomes an appreciating asset if you're fortunate. And then you have tax deductible mortgage interest and assets you can pass on to your family members. Now, the disadvantages, the property maintenance and the upkeep, because like they always talk, I talk to the young people and I always ask them, is a house an asset or is it a liability? Because there's a lot of cost in keeping up a house. And it's not as easy to move as renting. You can just drop and go if you're renting. But a house, is with you. Some people think that's a disadvantage because you can't get up and move like you want to or travel as much as you want to. But we're going to talk about those disadvantages and advantages throughout the night. And then you have the risk of losing your home if you in a negative position, where they call negative amortization, where your house is worth less than what you got to pay for it, like the economic downturn that happened to some people. And that's a realization. Or if you lose a job or have some kind of major permanent disability, it could lose your source of income, and you could possibly lose your home. Options for buying may include a single family house, meaning that's not attached. Then you got modular home or a townhouse. And, townhouse is like a row house. You got condominiums, which are, that they've turned a lot of apartments into condominiums. A lot of times, some townhouses, they treat them like condominium fees, and charge those kind of fees. Then you got co-ops, which you're sharing in the ownership. You might own like a couple of rooms in the house or one half the house. Those are co-ops, cooperatives. And then you got the manufactured or mobile homes, the homes that you've seen, like, mobile homes are, they're on wheels, they move it and put in there. And then the manufactured home, you might have seen them as you ride down the road. They carry a house and they have it split in two on different trucks, and they put them on the property and put them together. And those are the manufactured homes. But those are the options for buying. And let's talk a little bit about how much can you afford.
Yeah, that's a tricky one. Just from a personal experience, you don't ever want to be house poor. You don't want to put so much in your house that you can't do anything else. Now, the other side of that is if you have confidence in yourself when you're younger, obviously, and your income's going to be going up, which, as you move up in an organization or move up in your business or whatever the case may be, you don't want to buy less than you can. So you really have to take a look at how much house you can afford. And you don't want to buy too much house, but you want to, if you believe in yourself and willing to take a little risk, you might want to buy a little more house than you can afford, only because your income's going to be going up. But there's several different methods to gauge, and these are just estimates, just to give you a ballpark on how much you should spend for your house, or what price of house you should look for. Now, this doesn't take into account interest rates. This is just looking at how much you make and how much houses you can afford, how much house you can afford. You can take your annual gross income, multiply by 3. So if you make $48,000 times 3, the answer is $144,000. And again, that's just going to give you a ballpark. There's a bunch of other things that go into this. If you live in a high tax state like Wisconsin, the property taxes are real high. But if you live someplace like South Carolina, the property taxes are very, very low. Some places the insurance is real high, things of that sort. So again, these are just ballpark. The next method is take your monthly gross income times 30%. And that's how much you should spend on your housing costs. And that's going to include your rental mortgage, your payments, your insurance, utilities, maintenance, repairs. May not be realistic or helpful, but again, it's just a ballpark. You should be somewhere around this. You don't want to be off by 30% or 40%. You just want to be somewhere around here just to see if you're in a range that's reasonable. The third method is you take your gross income divided by 12 and then multiply by 0.3, and that gets you $1,200 per month. And that's the amount you should spend on your total mortgage payment, which we'll discuss in a minute, but that would be your mortgage payment to the bank or finance company, plus property taxes, plus your insurance costs. Okay, and the third method looks at your income, and you kind of back into what you can afford for your house is by looking at all your non-housing expenses, back that from your total net income, and whatever's left, that's what you say, I can spend monthly on a house, okay? And I think we have an example of that particular method. Yeah, if you make $3,500, it's $42,000 divided by 12, your total net income is $3,500, and that's your monthly. So your total non-housing expenses are $2,360. That's everything. That's your car payment, your food, your emergency fund,
Utilities.
yeah, utilities, everything else other than the pure housing costs. And the amount you have left is $1,140. That's what the maximum your house payment should be. And again, these are just ballpark estimates to give you a gauge to say this is how much my housing cost should be.
Yeah, you rolled through that pretty much though. That's pretty good. And these are just measurements and benchmarks that you can use, because remember, we are big on planning, and these are tools that you can use. Either one of these, it's going to run back because we went through them kind of fast. The simple one is just multiply your yearly income by 3. Gives you a ballpark of how much home you can afford. Then you have the 130% estimate on your actually housing cost. And then it's on the non-expenses and backing into it where you come up with how much monthly payment you can afford for a house. So we want to talk about steps to buying a home, right? And one of the first steps is determine your readiness to buy a house. I mean, this before you even think about buying a house or any large ticket item, like buying a car. One of the things you need to do first, you need to go pull your credit report and make sure that your credit is in good standing and you actually in the right position to be able to get better interest rates if you're buying a house. Determine your readiness. If you're in a job that is shaky, you might want to wait to make sure you have a solid income coming in. That's what readiness to buy a house. Then you need to determine how much mortgage you can afford. That's what Dope just took you through, because most people don't do it. They just think about it in their head. But you need some kind of formula to give you a ballpark so you can understand if you at least have some kind of measurement. Third, determine which mortgage option is best for you. There's several different mortgage options out there. We're going to talk about that. You need to look into that. And then the next step is qualifying for a loan. Go out there and finding a lender that is willing to take the chance on you based on your credit, and you get qualified for a loan. And then the last step is to go through closing, go through the settlement of buying the home. These are 5 primary steps. There's other steps, but these are sort of the primary things that you should be thinking about. Dope?
Okay, when you talk about your down payment and other expenses, most people, typically 20% is the magic number, because at that point, you don't have to pay the PMI, which is a separate mortgage insurance. If you pay smaller payment options, in some FHA loans, you can pay as little as 3% of the purchase price as a down payment and finance the other 97%. And again, that's going to depend on how much money you want to invest in your house. In some cases, it's a couple of different ways of looking at it. If you are a risky type of person and interest rates are extremely low, you obviously want to borrow as much as you can, especially at the interest rates that are out there today. And that would leave you more money to invest outside of that. But you'd have to be a person who's willing to accept a good amount of risk, because as we've always talked about, those investments could go down just as quick as they could go up, and you may need the money and you may not be able to sell at that particular point. So how much you put into a house, it can vary from as low as 3%, and you can put in as much as you want if you're trying to get a specific payment. But again, a guy like me would not pay, especially with today's interest rate. I'd rather have money in my pocket than money in down payment. And the value of the house is going to increase in spite of what your down payment is. So your value increase is not affected by how much you pay down. That's comfort level. Some people are more comfortable getting to the point of getting the house paid off and not having the house note, and that's okay. And the other expenses, and a lot of times people underestimate these because it was funny when we first bought our first house. It's amazing all the things that you have to buy that you've never thought about before. But you have emergencies, things break, you have repairs, you have other expenses, you have lawn maintenance, you have to make sure no weeds grow, so you have to have chemical treatments for your yard. There's just a ton of little costs involved that you have to make sure you account for when you're looking at things, what you spend on a house. And finally, that private mortgage insurance, that's a mortgage insurance that you have to pay typically if you pay less than 20% down. And most institutions, once you hit 20% of the 20% equity,
Loan to value.
Yeah, home value. Yeah, they'll release. You won't have to pay that private mortgage insurance anymore. And I don't know the exact percent, but it's not a big number, but it's noticeable in your payment. So, and typically, I've always paid down at least 20% because I never wanted to have any extra charges involved. But those are the big costs you have.
So there's a lot of government programs out there that have low down payment requirements. And Doak mentioned one like the Federal Housing Authority, FHA loans. You got VA loans, Veteran Administration loans. You have loans, which are private, but they are regulated by the government, like Fannie Mae and Freddie Mac. Then you have flexible underwriting standards that comes with a lot of the government programs, and that you don't sometimes get with private institutions that are providing loans for home buying. You have longer payment terms. You find out with a lot of government, they give you a little bit more leeway, but just remember, the longer the term, the more you end up paying more interest. And we'll talk about 15-year versus 30-year, but longer term payments, usually the government gives you a little bit longer time. They have longer extended mortgages. Sometimes like there's, 15, 30-year mortgages, and they sometimes have 40-year mortgages now. And then they also have homeowner education requirements, meaning that you have to take some kind of approved class that prepares you, if this is your first time home buyer, that you would have to take that is approved by HUD, and that educates you about all the things that we just talked to you about. And that's sometimes some of the requirements to be able to get these low interest loans from the government.
Taxes and insurance. And most of them are paid through escrow accounts. Now, me personally, I don't escrow. And the reason I don't is because I can pay my own bills. That's how most mortgage companies would rather they escrow, because number one, they want to make sure your property taxes are paid, so the municipality doesn't come in and take over your house, because they can do that if you don't pay your property taxes. And the same with insurance. It's kind of like your car insurance. They want to make sure your insurance is paid in case something happens to the house of which they have an interest in. It's just like when you buy a car. When you buy a house, the lien holder is the bank or financial institution that lent you the money. So they want to protect their assets. But me personally, I'd rather pay my own bills, because typically they usually have a little bit more than is needed, because insurance rates go up, property taxes go up. So they always want to make sure they have a little bit more money than usual. And I never liked that idea of a financial institution sitting on my money and in order to pay my bills. So I've always done that myself. And if you're starting a loan process, you can actually ask the bank, can you pay your own bills? Now, as I just mentioned, you have to be diligent, because you do not want to not pay your property taxes. You do not want to not have insurance on your home. So you have to make sure you pay those. But in a lot of cases, financial institutions will not allow you to not escrow. But that's always been a condition of me doing business with someone, is to not escrow.
Hey, Doe, I just like to give a shout out, man. We got several people out there watching, actually, people around the world. We got people watching from England and Scotland. But I want to shout out to my high school. No, not look. This is my elementary, junior high, and high school mate called McIntyre. Check this out. We both played trumpet in elementary school. Can you believe that? If I would have kept playing trumpet, I would probably have great knees. But I probably have messed up lips, so it's all relative. But what's up, Carl? Glad to see you. We got our frat brother Rob Robson looking out there, and we have the wonderful Now that's out there, as she always is checking us out. Thank you, Now. And then several other people want to say hello to you. I can't see all of you, but I notice I see you out there. Remember, click the like button, the heart button, and the more you do it, and the more comments you put in there, the better we are. So, hey, Dope, at this point, can you talk about a little bit real quick about mortgage insurance, not the PMI, but the mortgage insurance that people put on their house and pay extra, and you have a little interesting thing that you do.
Yeah, and it you have to look at it for what it is. It's an insurance product, and so the way it works is, let's say you borrow $200,000 to pay for your house. You can buy an insurance policy in case you die. They would take $200,000 worth of insurance and pay your house off. But like anything else, you have to shop that around to make sure that insurance rate is reasonable. And oftentimes you can buy another insurance policy, not necessarily called mortgage insurance, and find a lower rate. Now, me personally, I've never had mortgage insurance. I've always considered myself to be self-insured. So if something was to happen to me, obviously my wife would have more than enough money to pay the house off and do whatever else she needs to do. But some people swear by it. And again, they don't shop that rate around to make sure it is reasonable. And they kind of play on your heart. It's one of those things they sell and try to convince you that you're going to die soon and you need to make sure your spouse is taken care of. But again, it's just like any other product. And you can find a group life insurance that's a group life insurance rate that's cheaper, and you can do much better than buying it. Typically, you can do much better than buying it through a bank.
So we want to keep rolling here, though. I want to talk about mortgage terms. Thanks for sharing that. You got 15-year mortgage, you got 30-year. Like I told you, in some places, man, now they got a 40-year mortgage. They allow you to have that. And there's two thoughts on that. You got Susie Orman, who is a financial advisor, and then you got Rick Adelman. Susie Orman is all about paying your house off as soon as you can so you won't have that debt and you have all the equity. Rick Adelman is like, man, if you can get a 99-year mortgage, where are you going to get, if you had a $300,000 home, where are you going to get that kind of low debt maintenance of 3% or less than 3%? But the 15-year is, you borrow less money because of the larger monthly payments. The equity builds quicker, right? Because you're paying it off sooner. You're paying into the less interest to be paid, and you're paying off principal a lot quicker, and there are lower interest rates. But then you got the 30-year, which you can borrow more money because of the lower monthly payments, right? It's stretched over a longer period of time. But remember, because it's stretched over a longer period of time, you're going to be paying more because of the interest. It's built equity more slowly because the first 5 years normally is going to paying off the interest, going all totally to interest. And then as it usually on average past 5 years, 7 years, you're paying into the principal and you're paying the interest. And you can get more.
No,
Did you say something dope?
Yeah, and the other thing, this is another one of those situations where your risk tolerance comes in, because I could obviously pay my house off, but I could not turn down less than 3% money. And if you're able to deduct the interest and property taxes and things of that sort, your interest rate is even lower than that because, again, it's subsidized by the government. And if you look over the last several years, if you've taken that money you had in your mortgage and that you borrow, and you invest that instead of paying off the house, obviously you'd be way ahead. Now that's not a guarantee, because we always tell you things could go down as quick as they go up. But for me personally, that's kind of the approach I took. I didn't need to get a mortgage, but I got one, and I look at that money as money to invest. And I believe I can do better than 3% outside of having the money tied up in a house that you can't use.
And that's the thing too, because a lot of people like to be able to sleep at knowing their house is paid, but the downside is it's not liquid, because now it's going to be all in your house. If you paid it off, it's all in the house. You're either going to have to take out another loan, an equity loan, or you're going to have to sell your house to realize the dollar value of it.
Right.
Then next thing, you got the mortgage rate, fixed rate mortgage, which the interest rate cannot increase and the payments are predictable. Interest rates could go below that set rate. That's the downside. But then you got the adjustable rates. And around the 2008 meltdown, this would kill people, because they were telling people, get these interest rates, and people realized that these rates can increase or decrease. But they told them, but look, hold it for 5 years, and then you can refinance and get out of that, adjustable rate mortgage. And what they found out was people weren't able to refinance after 5 years, and the rates actually went up, and they could refinance because their credit got bad, so they were stuck with these balloon payments. But adjustable rate mortgage, like any other financial tool, it has a purpose, and it has a benefit for a particular purpose and a particular goal. So I'm not totally talking negative about adjustable rates. It just depends on, like we always say, what's your risk tolerance? Rates may be low for only an initial period of time, and monthly payments may initially be lower than the fixed rate loans, but can increase significantly. Then you have mortgage options. This is still me right there. Yeah. Then you have mortgage options. You got the fixed rate mortgage, adjustable rate, which is called ARMs. Then you have the interest only mortgages, and that got a lot of people where they would just pay the interest only, and those interests ballooned because you're not paying none of the principal down, and you be paying years and years just paying the interest, and you never actually, it take you so long to pay the house off because your monthly payment is not going towards the principal. Then you have the bi-weekly payment mortgage, and that's pretty cool because you can pay it off quicker because now you're making 2 payments a month as opposed to 1.
Well, you're making 13 payments instead of 12 because the 2 payments are usually split, divided by your regular monthly payment, but you end up making an extra payment. Obviously, if you pay twice a month,
right. That way, yeah.
Payments instead of 12. Okay,
yeah. Thank you, Doe, for that correction. Yes.
And as we've always talked about, you have to shop, compare, and negotiate. Look at newspapers and the internet for terms and rates, and negotiate your best price. Let lenders compete for your business. They will definitely do that. Get your costs in writing so you know what you're paying for, and make sure you're comparing apples to apples, because a lot of them have different administrative fees, but a lot of the basic costs are pretty much the same no matter which lender you use. Things like title insurance, local government fees, those things are the same. So a lot of times they put them in different places. They organize their offer sheets in different ways to make it confusing. But once you know what the basic costs are, you can compare those. And it's everything is negotiable. I can't stress that enough. I think I mentioned before, when I was selling my house in Pittsburgh, the lady real estate agent, her and I came up with the agreement that if my house sold within 2 weeks, she would give me 1% off of my commission, the commission that I pay her, because the seller is the one who pays the transaction commission. And 1%, I think my house sold for about $550. So that's $5,500 in my pocket that I didn't have to spend. And I did the same thing when I bought down here. Is I talked to several different real estate agents and found one who would give me a 1% credit at closing, which again, that's just money in your pocket instead of theirs. Most people will accept that if you ask. But the problem is a lot of people don't ask. You can't be afraid to ask for a discount. And you will never get it if you don't ask. But I've saved a bunch of money over my lifetime just asking people for a lower rate, a lower price, better terms, or whatever. You have to ask. Don't think it's set and go.
And that's in our negotiation classes at FDIC, though. That's with almost everything. I'm talking about down from a car to the toothpaste and the daggone CVS, believe it or not, is all negotiable.
Yes.
So tapping into your home equity, okay? Home equity loans. This is the value of your house that it grows. Equity is the amount that you owe for your house, and then the value of your house, what you purchase your house at, say it's $100,000, and then it grows in equity. The value grows to $125,000. That's $25,000 of equity. Home equity loans are out there. You can use these. You can borrow against those loans. Borrow against the equity, and you can actually borrow and get cash out based on the equity in your house. And then you have home equity lines of credit, which is called HELOCs, which acts like credit cards. You can have a house, and once again, we use the example of $100,000, and say you get the value of your house is now $125,000. You can get a home equity line of approximately, let's say, $20,000, and it's like a credit card. When you use it, it draws down on, and that's how much you end up owing until you pay it back. It's like a credit card. And then you have refinancing and cash out. And refinancing, okay, now I thought I got ahead. I thought I got ahead of myself. You can refinance your house to get a lower rate. If you got in and it was a higher rate and your credit wasn't that good, and then your credit got better, and you can refinance your mortgage to get a lower rate. And then you can actually take cash out. Like I said, if you had some equity in your house, you can actually take that cash out. And let's say you refinance your house was $100,000 and it was at a 7% interest rate. You refinance for a 3% rate, and the value of your house is $125,000. You can actually take cash out. Say you took $20,000 out, they will add that to the refinance amount. Now you owe $120,000, and you take the cash. That's how you can cash out. Then we have home equity lines of credit. Like I said, it works like a credit card. You draw on a line of credit as needed. You pay the principal, and available credit goes up again. As soon as you pay, when you repay that line of credit, the actual the credit goes back up on that. Then the interest rates are typically variable on HELOCs, home equity loan line of credits. Then there's advantages of home equity options. You got the flexibility to finance major expenses. Say, you had the furnace go out. The furnace cost about $16,000, and you didn't have $16,000 sitting in the bank. You can actually cash out on it, and you can, fund and get your furnace helped. You got low interest rates. They're usually lower than credit card rates. Credit card rates are usually up there around 18% or could be higher. And this is the other benefit. The interest is tax deductible. That's a major, major incentive. Dope?
Yeah, but just to back up, their interest is tax deductible as long as you use it for something related to improving your house. Okay.
That's right.
Yeah, you can't take money out and go to Vegas and bet a whole lot of money and then deduct the interest. It has to be a home improvement, or in some cases you can get a second line of credit or home equity credit as a first when you buy the house. But that's usually where it's usually a second mortgage involved. So they have the second claim on your house. Obviously, the first financial institution that you borrow from has the first claim. A home equity would be a second claim. That's why it's called a second mortgage. Next slide. We'll talk about some of the risk. And your house is collateral, and housing values can decrease. That's what happened to a lot of folks out west, where they had these crazy growth in home values, and people were borrowing the money. Then when the home values dropped, for example, somebody bought a house for $300 and financed $290,000. The value went to $500. They borrowed another $200,000, so now they owe $490. But then the house value drops back to $300,000. So they're what's called upside down. They own more on the house than it's worth. And a lot of people just packed their stuff and walked away. They just didn't pay it. And so you have to watch, because housing values can decrease. And in some areas I'm risky, in some areas I'm conservative. And this is one I would kind of steer clear of home equity unless I had a specific improvement that I was going to make. If I was going to add a bathroom or finish the basement or something of that sort, I typically, again, that's a personal preference, wouldn't do a second mortgage. As Bob mentioned, most of those are variable payments. So as interest rates rose, which if interest rates rose, you're stuck paying a much higher interest rate on that second mortgage. And like Bob always talks about those credit cards, that's not your money. In this case, this is not your money. This is the bank's money, but it's kind of hard to resist when you have that money sitting in your account to not spend it on something that is related to the house. So again, there are some risks, but there are some cases where a home equity loan can be very beneficial to you.
We want to talk about the refinancing option. I talked about it there for a minute, where you can pay off an existing home loan and replace it with a new loan, normally with a less interest rate. Is normally why you refinance. And then I talked about cashing out, where you can borrow more money than owed on the loan to be replaced. And like Doe said, my personal preference is, you should. I don't like using home equity loans. I don't like cashing out, because then you have to pay. Now, it's just a need, and we always talk about that. You got to be careful, because it can't be an unwise purchase. You're just using it to go to Amsterdam or something like that. You're now increasing the value of your house. Remember, one of the things, the disadvantage we talked about your house, homeowners, you could lose your house, and that's real. So I don't like using home equity loans. It's good to have it available in case of emergencies, because things do happen. But at all times, you should not use your house and put your house up. No,
you skipped one slide. We're going to talk about rental property.
Oh yeah, there's not a slide for that, right?
Yeah, and just want to mention that as a viable option is to buy a multi-unit place and have someone helping you pay your mortgage. Because the way I always look at it, if you're paying rent, you're paying somebody else's mortgage. But if you get a multi-unit building or place, someone is helping you pay the mortgage. And the other big advantage is most things that you buy for that building would be tax deductible as a business expense, because that is an income producing property. And so if you got a 2-unit, you live in half, you rent out half, they're in effect paying a good portion of your mortgage. You still build equity, you still have that investment base of home ownership, but you have someone helping you pay the mortgage. And that's a great way to start, especially if you're younger, because you can get a nice size house, and there are perils to being a landlord. And that's the main reason I've never got involved in rental property. But I mean, it's kind of a trade-off, the perils of being a landlord versus the fact that you're having someone else help you pay your mortgage. You'd have to weigh what you're most comfortable with and then proceed.
And Doug, before we wrap this up, I want to share with people, there's a long-standing conversation about renting versus owning a home, because a lot of people say, if you really factor in all the costs of home, I'm talking about the down payment, and you're talking about the maintenance costs, you're talking about the interest payment over time, over 30 years, and you talk about the property taxes, and you factor all that in, they usually say, man, you end up paying way more money, but that's not true. If you do take a basic example of a $250,000 home, and you take all those factors involved, you end up paying $923,000 for that house over time, right? If you live to 80 years old. If you're renting at $1,766 a month, it will cost that same time frame you would have spent $1.2 million. So you come out $200,000 ahead. And that's not even including the appreciation value of the house and also keeping pace with inflation. So the issue of owning a home definitely outweighs renting a home in the long run. Yeah, just want to take y'all, we want to bring this on home, dope.
Hey, but from a personal experience, as I mentioned before, I've relocated 9 different times. I bought my first house when I was 25 years old, and we bought and sold 9 different houses. And I just went back and took a ballpark. I think I've made over $500,000 in total buying and selling houses. I never had a house lose value. Some didn't go up as much as I hoped. Some went up way more than I thought they would. But all my houses increased in value. I was in one house for 11 months, but it went up $60,000 in that short period of time. And so I'm a strong believer in buying a house, and typically house values will increase. Not a guarantee, but again, in my personal experience, that's $500,000 that I made that I did not have to pay tax on. That's pretty much in your pocket.
So this is some of the takeaways from our session today is you must live someplace, so figure out which is most advantageous for you. And if you can buy and own, you might want to consider that, because it's just that way. It's a great asset.
Yeah. Understand all the costs involved with a mortgage. Again, it can be tricky the way they present their information. Always make sure you understand everything, every cost that's involved in your contract.
And the second one, it sort of ties to the one above it, but it actually is a little different. Other than the cost, there's other obligations that you're assigning in that agreement, and you need to make sure you understand what you're assigning. So you need to read the entire document. Nowadays, the closing document is now just 5 pages. It used to be way more pages than that. Now you sign more documents to actually close the loan, but as far as the actual, it used to be a HUD settlement sheet that was 17 by 11 by 17, and almost 100 pages. You don't have to do that anymore. Thank God for that. And the loan estimate is about 3 pages, and it sums it up real good for you. Read those documents.
Yeah, shop, compare, and negotiate. Can't stress that enough. Look around, find a cheap rate. I've refinanced through Costco. I mean, they have a relationship with a mortgage company, and they give you all kinds of extra perks for using them. And typically when Costco signs an agreement with a vendor, they make sure that vendor treats their customers right. So look around, compare, and negotiate. Everything is negotiable. So make sure you're getting exactly what you want at the price you want to pay.
And refinancing can be a source of cash if you need it. But note, make sure you need it.
Yeah. Owning a home can save you a lot of money over your lifetime. And again, you got to pay to live someplace. You get to the point where you do get your house paid off. Then you're living mortgage free. That's a lot of money you can put in your pocket.
And last but not least, you can't have everything you want, but you can have the things that you need. And that's so, but you can have this, you can't have everything that you want, but you can have the things that matter. And owning a home is a great way to start building wealth on your way to building wealth and closing the wealth gap. So with that, does anyone have any questions or have any comments or anything they'd like to add? Please put them in the comment box and we will see them. I'd like to say hello out there to Terrell. Good to see you listening in. Appreciate that big time. And we're here every Thursday at 8 p.m. Dope, we've come to that time on the clock where we can close this out. Another great informative show. Just remember, your home ownership is key. It's one of the ways that leads you to creating wealth so that you can pass it on to your kids for generational. Anything you'd like to close with, Dope?
Hope everyone stay safe. Have a wonderful night and stay safe.
And remember, it's either mask it or casket, okay? All right, look, I'll talk to y'all later. It's good. Thank you for hanging out there. Thanks for all the people that tuned in. Our frat brother Rob, who's a stalwart, that's with us all the time, and all my FDIC friends out there that step in. And I know my girl Garnett is out there somewhere today. We appreciate you. Thank you all, and stay tuned for next week. The FITT Show, financial information for today and tomorrow.